Hello there, this is Gian Roberts with RetireYounger.us. The author of Retire Younger wrote this book back in 2016, and today I want to talk to you a little bit about my feelings about the stock market and why I think 2019 is the year that you need to move your money out of stock investments into a cash flow investment. And I'm going to give you some strategies, some insights of why I think this and why you should consider this as part of your investment plan. Now, the idea behind Retire Younger is that we give you a three-step process in order to develop a lifetime income. That means an income that's going to last your entire lifetime and have you generate a six-figure annual income without losing any capital. Most traditional investment plans are set up in very similar ways. Basically, you spend 20 to 40 years saving towards retirement, building up a nest egg of cash, and when you get to retirement, you're supposed to, during this phase, you're also trying to get a return on your investment and trying to multiply the amount that you'll have saved up for retirement. And what's supposed to happen is that you're supposed to start spending some of that savings. What we propose to do is to take that seed capital, that nest egg, and then invest it into a safe, secure investment that's secured by a hard asset, which allows you to then never risk your seed capital. You always get the seed capital returned to you because of the way that we invest into the hard asset, because we invest at deep discounted prices. So the problem that I have with investing in stock, and of course I'm not a financial advisor, nor should you take my advice today and take any action on it whatsoever. This is just my opinion, and if you want to learn more about what we have to offer and why I think cash flow investments are a better way to go than stock options, go to this link, retireyounger.us/call, CALL. If somebody could type that URL into the comments below, I would really appreciate it. I don't have access to the comments at this time. So if you could type in retireyounger.us/call, and I'll be glad to talk to you one-on-one. I set some time apart this week so that I could talk to you one-on-one and discuss your current situation and see if I can give you any insights or a game plan. Also, I'll review this book with you. I'll do a book review with you and see if there's anything in here that might apply to you and your investment goals. So, if you saw the news this week, you saw that Apple, the first trillion-dollar business out there, right? They had lower than projected sales by $75 billion, right? Because of the slacking China market and lower sales over there because of the economy over in China, and people are getting less are getting kind of frustrated or getting behind being able to pay for these installment plans that they have set up, because it's just every 2-year cycle where they're starting a new installment plan to upgrade the phone, and it's just this constant burden on them because it's like paying a mortgage, right? to pay for your phone. Um, and so there's been some resistance to upgrade their phone because of this. And so this happened, right? And so what happened to the stock market? It dropped by 600 points in one day. And so if you look at the market, the stock market always goes up, and then it goes down, and then it goes up, and it goes down. Right now we're at record highs. This is never in the history of the world has the stock market been this high as far as point values. Some of this is caused by quantitative easing that we had over the last 4 years or 8 years, if you want to look at it. Quantitative easing. We had the crash in 2008, which made some banks default. It made some car, like Ford and GM, almost go into bankruptcy if they weren't bailed out by the government. So, so we had that 2008, and now it's 2019. So we're at an all-time high. 2008 was a low. Now we're going into a high, so there's nowhere to go but down. And before this week, there was a couple weeks of 400-point drops in the stock market. And here's the thing. Putting your money in the stock market at this point and keeping it there, you're going to have a loss. Unless you have some type of index fund that's going to keep it at where it is. But if you don't have it in an index fund, you're going to lose money, right? And then it takes years to recover from a loss in the stock market. So the reason why I recommend that you pull some of your money or part of your money, or what I would do is I pull some of my money out and invest it into cash flow investments because it's invested into a hard asset, and it's also an asset you can control. Now, taking your money and putting it in the stock market is a lot like going to Vegas and gambling with your retirement money. This is not what I recommend you do. I recommend that you hold on to every dollar that you've been able to put aside for retirement and cash flow that so that it multiplies. With the stock market, everything's rigged against you. First of all, there's 33 different fees that come out of your investment capital. All right? So you've got all these fees, and you don't even know all the fees that come out of your investments. The brokers, they make money whether you make money or you lose money. So they're going to recommend that you keep your money in there because they're getting paid their commission no matter what happens to your money. You have zero control whether the market goes up or down, right? You have zero control whether the market goes up or down. And it goes down a lot faster than it goes up, right? So that's another thing that you should consider. And finding a winning stock is, it takes a lot of knowledge and a lot of experience in order to pick a winning stock. Even if you have even if you invest in the index, the entire index, typically those index will only gain about 6% return annually, and then in down markets you don't gain anything, right? So here's the benefit of what we offer, okay, or what cash flow investments offer. First of all, we invest in hard fixed assets. We invest in two things. First, it's real estate, and we're talking about single family real estate, not not apartment complexes, and not multi-unit investments. And I'll explain why we do that. And then second, we buy businesses through acquisitions. These are businesses that have been proven to perform even in a down economy, and we can predict how that business is going to do. And businesses like Warren Buffett invest in businesses. Businesses tend to make a profit. That's what that's what they most business, every business has to go into business to make a profit. That's just the way they are. So they're structured in a way so that they can make a profit. And so they can make a profit in a down market or an up market. So that's why we invest in businesses. But that does require a little more capital than purchasing a single family unit. So there's three stages to building wealth within a cash flow model. The first stage, the first pillar, if you will, is that you have to eliminate any debt that you have. So credit card debt, mortgage, car loans. You want to reduce the amount of debt that you have so that you can put that capital towards the cash flow investment. Alright? So some of you have poor credit. It's important that we fix your credit, and with the new FICO Ultra coming on board this year, you're going to have to show two things. First, your credit history is still going to count the same, but they're also going to check your bank account balance, showing that you have enough funds to support extra debt that you bring on. So the Ultra FICA is going to make it more challenging for those people who are just meeting the minimum payments on their credit cards, and so they're going to need extra capital. And so that brings us to the second phase of the program. The second phase is creating a side hustle, something that generates you an extra income on top of what you're already making, so that you have a better account balance, and B, you'll have more to put towards a cash flow investment. Now, when we're talking about cash flow investment or having capital, you can use a 401k, an IRA, a pension fund, or just cash savings, or other type of savings plan. But you have to be able to roll it over into a self-directed plan. One of the companies we use is Equity Trust. Equity Trust will move it over into a self-directed IRA, or move your money over to a self-directed Roth IRA. And we recommend doing a Roth IRA, but you don't want to move all your capital into a Roth IRA because you have to pay your taxes. Would you rather pay your taxes on the seed, on the lesser amount of money, or would you rather pay taxes on the mature investment, right, where you've doubled or tripled your money that you've invested? Well, the answer is that you want to pay on the seed. You don't want to pay on the harvest, right? So a lot of people are deferring their taxes into retirement. So your tax bill is going to come out in your retirement. So this could be 30% of whatever you saved up and were able to invest and multiply. So 30% of that goes to the government in the form of taxes. So now you have 30% less in taxes. The same thing happens with stocks. When you make money with a stock, then you have to pay taxes on that money. And so any gains that you made with the stock from your seed capital, is reduced by 30%. So you have to make that much more in order to really make real gains with your stock. Alright, so here's what we do with a cash flow investment. First of all, we start with the seed capital that we've already paid taxes on, right? Then we move that money into a cash flow investment. Now, a real simple example here of a real estate transaction that we could do where you can double, or we'll just say double your money, right? Basically, you have the asset, which is a house valued at around $100,000. The reason we focus on the lower end of the market is because that's where 80% of our buyers are going to come from. All right, because these are people that don't typically qualify for a traditional mortgage. So we become the bank. We want to become the bank in our investment model, and you can find out. I have a whole video that shows you our investment model. But basically, we have the piece of real estate worth $100,000. We invest $50,000 into this real estate property. Now we do that because we're paying all cash from our seed capital, and there's usually something wrong that has to be updated in the property. A new roof, new AC unit, something has to be done to the property, but it has to be livable, right? So it has to have electricity, running water, plumbing, things like that. Then we advertise that and put a lease option tenant in there who's going to be making payments on this. They're basically leasing to own the property, and it's a 7 to 10 year contract. So it's a long-term investment. That way we double our money, and we make up to $50,000 in profit on this piece of real estate over that term of 7 to 10 years. So now we got that extra $50,000, and what we do with that extra $50,000 is we purchased a maximum funded life insurance policy. And what this does is it triples our buying power to build up our retirement savings. So we can easily pay with that money this maximum funded life insurance policy. Let's say it's $1 million policy. What we can do is we can borrow against that policy tax-free and use that as our retirement funding mechanism. So we have that initial seed capital that gets cash back to us, so we still have that initial $50,000 that we invested, right? That gets returned back to you, plus an additional $50,000. And there's some more money involved in there, but instead of managing the property yourself, is to hire a manager to take care of that property for you, so that it's automated and passive. And you just take that $50,000 paid for that maximum funded life insurance policy. You can borrow against that policy between $50,000 and $100,000 a year. This is where we're getting the 6-figure a year income, depending on your life expectancy. You can borrow up to 6 figures per year. When you pass on, that policy balloons to $2 million, then pays off that $1 million loan that you have against the policy, and your cash flow investment is paying the premium every month. That's totally automated, and it pays off the loan, and then whatever's left over goes to your heirs and your beneficiaries. So that's one way of doing it. There's another method for people who are over 70 years old. It's a little bit quicker method because the life insurance takes about a 5-year window to mature, where this next method is a self-directed Roth IRA. And so what you do is you take your seed capital, put it into the cash flow investment. It makes a profit. That profit then goes to fund a Roth IRA. It's pre-taxed as it goes in. It builds up value inside that Roth IRA. Let's say you had $20,000. to $50,000 in there, right? You can partner with other investors. Let's say you have two investors. You can partner to buy a $100,000 house, and then cash flow it, and then all the money that you make from the property, if you invest through your self-directed Roth IRA, then comes back to you as profit and tax-free profit at that. Another way that you can use the Roth IRA is to do a wholesale deal, and so basically we show you where you can find discounted property. You purchase it at 50% ARV, which is after repaired value. You sell it at 70% ARV. You make a $10,000 to $20,000 profit, and then whatever your down payment was goes back to the Roth IRA, plus the profit you can put in your back pocket. If you're over 59 and a half, you can put that money in your pocket tax-free and spend it, and you can do one or more of these a month, making a $10,000 to $20,000 profit tax-free by using your Roth IRA as the vehicle to fund the initial down payment for the property. Then you sell it to a wholesaler who pays all cash, and then you just keep repeating this process in perpetuity using a self-directed Roth IRA. So if any of this interests you, please leave your comments below in this box. Make sure you like this video. Make sure that you share this video. It's very important you share this video. If you share, like, and comment at this video, and then you go to retireyounger.us/call. If somebody could put that in the comments, retireyounger.us/call, CALL, and then schedule a phone call with me. I'll give you lifetime access to my elite training course, which is a $2,500 value, absolutely free. Okay, so again, what you need to do is you need to like, comment, share this video, whether you're on Facebook or YouTube or wherever you find this video, and then schedule a call with me, and I'll give you lifetime access to my $2,500 program. That process that I just described will show you step by step how to do this process for yourself, how to partner with other investors, and how to grow your retirement lifetime income. So I go into great detail in this program. That's why I charge $2,500. I call it my partner program because I actually partner with you and help you set up your own retirement fund and help you make a lot of money on the side. You might be, have a good income with your career, but you might need some extra income so you can set it aside for retirement, for that seed capital, cash flow it, then put it into either a Roth IRA or into a maximum funded life insurance policy. So that's it in a nutshell. I hope this was helpful. This video was helpful. You can't do any of these things with the stock market, right? You can't partner with other investors in the stock market. You have to raise all your own capital and put it in there. You can't control anything about your money or the stock market in an investment. You're competing against supercomputers that are trading in milliseconds, right? You can't win against a computer that's trading, faster than you can process information. There's 33 different fees that come out of stock market with our cash flow investments. All the fees are given up front. You can get predictable results with our cash flow system. Plus, if you like, share, comment, and schedule a call with me this coming week, I'm going to give you lifetime access to my elite training program. That's going to show you how to set up this cash flow system all by yourself. Plus, you're going to get a free copy of my book here, Retire Younger. So go to the website, retireYounger.us/call. And again, if you could comment below and leave that URL for the next person who comes along and watches this video, I would really appreciate it. And again, make sure that if you're on YouTube, subscribe to this channel. If you're on Facebook, like this video, like the page. I'm also going to give you access to our private members Facebook group if you schedule a call with me this week as well. So there's a lot of opportunity for you, and I'm actually going to give you access to our partners list so that you can literally make connections and start making real estate deals with none of your own money or capital, and start making up to $50,000 per real estate deal. All that's going to be explained to you later on. So definitely, this is the year. If you're in the stocks, if you have money invested in the stock, whether it's through your 401k, IRA, pension funds, or other type of retirement savings plans, this is the year to start migrating some of that capital into other investments, diversifying your portfolio, and reducing your risk for when the economy and the markets go down, so that you're not left holding, losing money in stocks and not having any return on your investment capital, because it's very important that you use the power of compound interest to build your retirement funds. So until the next video, this is Gian Roberts, and I'm signing off.